Both of you joined, mom?
Yes, sir.
Yeah, okay. And one, I will share the screen. And screen is visible now.
Yes, sir.
Okay. We have seen material levels, right?
Yes, sir.
Okay. Material level problems. Any doubts are there? Have you worked out problems based on material levels?
Yes, sir.
Maximum level, minimum level, reorder level, average level. Okay. So let us see some more points relating to materials. Yes, another problem faced by management is that at what price materials are to be issued from stores to production department. So stocks are counted in two ways, periodic stock taking and perpetual stock taking. Periodic stock taking means stocks are counted at regular intervals of time, and in case of perpetual or continuous stock taking, the moment the transaction is happened, the stock balance is arrived and the stock value is arrived. So balance of stock can be both is expressed in both quantitative terms and value terms. So, so what is the value of stock that is consumed in the production department? What is the material cost? So, because materials are purchased from different suppliers on different dates in different lots. So, what should be taken as the cost of raw material consumed or used? So, materials are issued from stores to production department. Now, at the time of issue, as far as the quantity is concerned, we don't have any difficulty. But the price, at what price they are treated as issued to the production department. So for this, we do basically the pricing of issues are categorized into three methods. One is cost price methods. Second one, derived cost price methods. Third one, notional price methods. Under cost price methods, the materials are treated as issued, the price at which they are purchased. So they are issued at the price at which they are purchased. For example, under this we are having five methods: first in first out method, lost in first out method, LIFO, FIFO, LIFO, base stock with FIFO or LIFO, specific price method, and highest in first out method. So like this we are having five methods. And in the first method, first in first out method. So prepare a stores ledger account from the following information adopting FIFO method of pricing of materials. March 1, 2016, opening balance 500 tons at the rate of 200 rupees per ton. So like this, So stores ledger, and they didn't write other details like name of the raw material, description, code of the raw material, reorder level, minimum level, maximum level, uh, danger level, and pin number, location code. So like this, we have to write all those details on the top of this stores ledger. And we are also not getting many problems based on this because the students are expected to have a good knowledge about these methods at degree level, especially commerce students. So they are concentrating on EOQ, economic ordering, quantity-based problems, many problems, and workout problems from the solve scanners. Working out all solve scanner problems is a must thing for preparation of this professional course. So data stores ledger is divided into data or particulars. We will write GRN or MRN, but that is not shown here. And then receipts, issues, balance. Under each of the case, we will write 3 columns: quantity, rate per unit, amount in rupees. So quantity, price value, quantity, price value is written as 3 sub columns in each case. So March 1, 2016, opening stock 500 units quantity, 200 rupees per ton. So 1 lakh rupees, 500 into 200. So next, what is coming? March 3rd, 70 units are issued. 70 tons are issued. And just before the issue, what is the stock available that we have to see? That is 500 tons are available. So we are taking 70 tons and out of 500 tons, and the corresponding price is 200. These 500 tons are purchased at 200. So 70 tons, the issue price is also 70. And in particulars column, we will write MRN, that is material requisition number. So materials are issued from the stores department, and then the document that is issued from the production department. The document is called MRN, material requisition number, or material requisition slip. So issue 70 units at 200, 14,000. Out of 570 gone, balance 430 is there. And at 200 rupees, it is 86,000. And next, again, issue is there 100 tons. They have given on 4th. And even 5th also 80 tons are there. So 100 tons are now issued. Immediately before the issue, the stock is 430. Only 1 lot is available. Corresponding price is 200. At 100, 200 rupees per ton. 100 into 200, 20,000. Quantity minus quantity. 430 minus 100 is 330. And so 330 into 200. 66,000 is the value of the stock as on 4th March. And now 80 units are issued on 5th March. Again, out of balance 330 units left, or 330 tons, and corresponding price is 200. 80 into 200, 16,000. 330 minus 80 is 250. 250 into 200, 50,000. And now on March 13, after March 5th, there is a March 13 transaction received from suppliers 200 tons at 190. And so we will write in the receipts column. So when goods are received, they are received from the quality control department. We call it as our goods inspection department. They will raise a document called GRN, goods received note. Based on that, 200 tons are received, and in particulars column we will write GRN 200 into 190, 38,000. And now already 250 lot is there. So first we will write the 250 lot at 200, then 200 lot at 190. So in all cost price methods, we will write the stocks identifying the lot wise. Separately, we will write and what is the stock position is arrived. After this, again on March 14, return from department A 15 tons. So materials returned note will be prepared by the production department, and these are written These are returned against the issue price of 200 rupees because there was only one lot that is used for issue so far. So therefore it is taken at 200, 15 into 200, 3000. And now three lots we have to write. One is 250 at 200, 200 at 190, and 15 tons at 200. So that is written in the next page. So one lot is written. One lot is written on the previous page and the two lots are written in the next page. On March 16th, there is issue. Issued at 180 units. Issued 180 tons. So on March 16, immediately before the issue, what are the lots available? So the lots are 250 at 200 and other two lots 200 at 190, 15 at 200. So since we are following first in first out, we will issue from the first lot immediately before the issue, that is 250 is available. Out of that 180 we are issuing. Since we are taking the lot from 250 units lot, 180 units are issued. The corresponding price is 200 is used. Out of 250, now 180 gone, balance 70 at 200 and 200 at 190, 200 tons at 190 and 15 tons at 200. After this, now a receipt is done, 240 tons at 195. So as and when we are purchasing, that will be written as lost lot, and the previous lots are to be written as it is, as part of stock, closing stock, without changing the order. We should not alter the order. And what is existing as earlier, that we will be writing 70 at 200, 200 at 190, 15 at 200, and 240 at 190. So now on March 24th, so 300 are issued. So when 300 units are issued, 300 tons are issued, since we are following first in first out, we will take from the first lot 70, then 200, 270, and then 15, 285, and remaining 15 tons are taken out of the 240 tons. So 15 tons at 195, and balance what is left, only last lot is left. Out of 240, 15 is gone, 225 is available, and at 195 rupees price, value is 43,870. Are you able to understand how these lots are written? As and when the new purchase is made, it is written as last lot. As and when it is issued, from the first lot immediately before the issue, what are the stocks available from that first lot, materials are issued. Anywhere you are able to, anywhere you are not able to follow in these figures? Is it understandable or not?
Yes, sir.
Yes, sir.
Yeah, good. So I hope rest of the things you can do on your own, because only 2 more transactions are there.
Yes, sir.
And now we will go for LIFO, last in first out method, another cost price method. So cost price methods, what we mean is that materials are issued from the stores department to the production department at the purchase price at which materials are purchased. So from this information provided as under, you are required to prepare a statement showing how the issues would be priced if LIFO method is followed. Opening balance of 100 units at 10 each. Received 200 units at 10.5. So there are various receipts at prices. Definitely the question what we have to answer is the issue price at which we are doing. In this method, what we will do, So before the issue. So on 4th is the first issue we are making. Before we are making the first issue on 4th, what is the stock available? 100 units at 10, 200 units at 10.5, 300 units at 10.6. When we follow first in, first out, first we will exhaust the opening balance and then subsequent lots we will be doing. But now, before the 400 units are issued on 4th, what were the lots available? 300 units at 10.6, 200 units at 10.5. So first we will exhaust 300 units. After that, 100 units I will be taking from the 200 units of 10.5 each. So now what is the stock is 100 units at 10 and 100 units at 10.5. So let us see how it is coming. Yeah. So February 1st opening stock 100 units at 10 and 200 units at 10.5 are purchased on February 2nd, 2100. So already 100 units at 10 is there and now 200 units at 10.5. And now again on February 3, 300 units at 10.6 are purchased. So we are already having 2 lots in hand and now third lot is purchased for 300 units at 10.6 rupees. So 100 units at 10, 200 units at 10.5, 300 units at 10.6. Okay. Now on February 4th, we are issuing 400 units. So immediately just before the issue, what are the lots available? 100 units at 10, 200 units at 10.5 and 300 units at 10.6. So we should take from the last lot. The last lot immediately before the issue is 300 units at 10.6. That is taken. And then 100 units is taken from the previous lot. That is 2 out of 200 units, 100 units are taken at 10.50 by say. So now only, so 300 plus 100, 400 units of stock of raw materials or of tons or units, whatever it is, they are issued to the production department. What is left over is 100 units at 10 is there, and out of 200 units at a price of 10.5 is the stock. Now 2 lots are available as closing stock as a stock as on February 4th. And now again 120 units are issued. So immediately just before the issue, there are 2 lots. One is 100 units at 10.5 and 100 units at 10. So first you will take 100 units at 10.5 and remaining 20 units you will take from out of 100 units of the first lot. So that is balance left over is 80 units at 10 rupees. So this is only 1 lot is available. After that, February 7th, we are buying 400 units. So GRN goods, this you will note, 400 units at 4,400. So 80 units at 10 rupees, 400 units at 11 rupees. So now a new lot is formed. So as and when materials are purchased, we will be adding the new lot and write them. And whenever we are issuing, immediately just before the issue, what are the lots available? From that they are issued, materials are issued. So that is lost in first out. So the rest of the 2 or 3 transactions you can do yourself. And because I want to cover all the other models also. So basically under cost price methods, we are having FIFO method, LIFO method, base stock method, specific price method and FIFO. Under base stock method, actually base stock is the minimum quantity that is kept for emergency purposes. They will tell you in the problem 400 units are kept as base stock out of opening stock. Opening stock is 1000 units at 10 rupees. And you cannot touch 400 units. So balance 600 units, you can use it for issue. If it is FIFO, we will follow FIFO order, first in, first out order. If it is LIFO, we will issue from the last lot. The rest of the calculations are just as what we have done just now. So it is a combination of base stock minimum quantity that is to be kept plus FIFO and LIFO. Next is the specific price method. In this method, sometimes materials are purchased for a specific purpose, to meet out the specific job order or specific contract undertaken from a particular supply. So materials are identified separately and kept aside. The moment the customer gives the order, materials are issued to the production department by the stores department, and this is also operating as along with FIFO or LIFO. So specific price with FIFO or specific price with LIFO. Like this, it goes. Highest in first out is immediately just before the issue. What is the lot having highest price? That will be taken. Suppose here we will see on February 4th, they are issuing 400 units. So what is the highest price is 10.60. The next highest price is 10.5. So this is the stock 300 units at 10.6, 200 units at 10.5, and 100 units at 10 rupees. So the highest price is 10.6. From that lot, we will issue. And after that, if that is not sufficient, the next highest price will be taken. So these methods are not so popular. And we will go to the next. So if I am explaining in the order of questions available here, it is a replacement price method is coming under notional price methods. So under notional price method, we are having standard price method, replacement price method, reuse price method. So inflation method. So under replacement price, what is meant by replacement? Is buying something new one in the place of the old one. So it means when materials are issued, from the stores department to the production department, so it is necessary for the purchase department to buy and replenish the stock. It means to restore or to replace the stock, because in future again issues are to be done. So they are purchased some time back, say 1 unit at 10 rupees. Now it is available at 10 rupee 20 paise. So the market price is the 10 rupee 20 paise. So what is the prevailing market price as on the date of issue? That will be taken as issue price. So purchase price will be given in the problem, otherwise we can't solve it. And so prepare stores ledger account showing the pricing of material issues on a replacement price basis from the following particulars. On 10th, on opening balance is 400 units at 14 on 1st March, and 10th March received 100 units at 4.1. 15th March issued 300 units to job XY by the material requisition number 14. Then 17th March 2016 received 200 units at 4.3, and 20 units at 3. On 20th March issued 250 units to job AB by MRN 20. So they have given only material requisition number, and in these problems they will be saying what is the price as on the date of issue. So you can see here replacement price on various dates. On 15th March 4.20. So we will be issuing at 4.20 on 15th March. You can see here. So opening stock 400 units at 1600, and on 10th March 100 units at 4.1 purchased. 104.1 is 410. So already opening stock was 400, and what is purchased now is 100. Total 500. So in this case, other than cost price methods, In all other methods, we will not identify the stocks lot wise, and we will show them as a combined or clubbed quantity. So 400 plus 100 is 500. Quantity plus quantity will merge, and value is 1600 plus 410 is 2010. So replacement and the price per unit we need not write in the last column. Actually, they have written by dividing the total value with the number of units in hand. So 4.02. So that is what we say weighted average price. But writing it is in no harm. But quantity plus quantity, value plus value when materials are purchased. When they are sold, quantity minus quantity, issued quantity, balance quantity will come. Simple. And value minus value is the balance value. On 15th March, 300 units, and they have given what is the issue price here, purchase price. Okay. Are you able to identify in your study material? Both of you are having hard copies.
Yes, sir.
On 15th
sir.
March, on 15th March 2016, it is 4 rupee 20 paise. So at that purchase price, materials are issued because at this price now materials are available for replacement. The purchase department will be replacing at this price. So this price is used as issue price. So they are purchased at 4 rupees, and first lot is purchased at 4 rupees, second lot is at 4 rupee 10 paise. But replacement price comes as on the date of issue, its price was 4 rupee 20 paise. Materials are issued at a replacement price of 4.2. 300 into 4.2 is 1,260. So immediately before the issue, there was a stock of 500. Because of issue, that stock comes down from 500 to 200. 500 minus 300 is 200. Value minus value, 2010 minus 1,267. So whenever the materials are issued, we have to subtract like this. And when materials are purchased, we have to add. So 200 units are purchased at 4.3. 200 plus 200, 400. Value plus value. Value is 750 plus 860 is 1,610. Are you able to understand now? So how this 1,610 has come? So 750 is the value, and the purchase price of the next plot is 860. So okay, right? 750 in this 860. Because we are buying on 17th March. Already quantity was 200 is there. 200 plus 200, 400. Value plus value 1,060. 1,610. So 750 plus 860. 1,610 divided by 400 is 4.03. That's what the weighted average price.
Sir, what about this 4.02, sir?
4.02.
At 10th March 2016.
That is only weighted average price. That's all. They are dividing the total value of the quantity available in hand with the total units in hand. That's what actually, even if you don't write that middle value and that is rate per unit or price per unit, that will not harm anything. So because in the column, in the last column total, we will show only what is the quantity and what is the value.
Okay, sir.
Next method is standard price. Stocks are issued at a standard price, and the following transactions are occurred for a specific material. And standard price is the price which is determined in advance based on the past experience of the business entity, and they'll be fixing the standard price. So materials, standard material cost or material cost of raw material that is used in a given actual output, it must be achieved within the standards. So because this is in order to achieve the control over the material cost, but actuals are deviating from the standard fixed. So in this method, we will show all receipts at actual prices and all issues are at only one price, that is the standard price, that because that is fixed. So here you can see down. So the debit balance of price variation on 1st January was 20. So show the stock account for the material for the month of January, indicating how you deal with the difference in material price variance when preparing the profit and loss account for the month. So here, what is the standard price per ton is not given. So what we have to do is opening stock, value of opening stock. What is the value of opening stock? 10 tons of 240 per ton. So 10 into 240. Plus, if it is a debit balance, we have to add. They have given debit balance or unfavorable balance or adverse balance. Whatever the name they are giving, we have to add. If it is favorable balance or credit balance, we have to subtract. So 20 rupees is the debit balance they are given in the question. You can see here the debit balance of price variation on 1st January was rupees 20. Are you able to identify?
Sir.
So
Yes, sir.
first opening stock is 10 into 240 plus this 20 rupees. Debit means you add it, credit means you have to subtract it. So 10 into 240, 2400 plus 20. 2420 divided by opening stock in tons is 10. So 2420 by 10 is 242. So this is the issue price. Standard price at which materials will be issued is 242. And whatever the rate at which you are buying, the issue price is always 242. You can see here.
Okay, sir.
So sometimes they will say issue price is the standard price of 242. Standard issue price is 242. They can say straight away, but generally to take your time, they will be asking a question like this. The rest of the things are as it is. So your opening stock is 10 units at 240, 2400. If they have not shown here the price rate per unit, because rate per unit for balance also we will be showing only for cost price methods, that is FIFO and LIFO methods. For all other methods, we will club the quantity and we will club the value. We will show the aggregates. So 10 tons at 240, 2400. Now 5 tons are received on 4th January and at 260 rupees. 5 into 260, 1300. Already 10 tons are there in the stock. So 10 plus 5, what is received now is 5. 10 plus 5 is 15. And 2400 is a value, plus now what is received is 1300. 2400 plus 1300 is 3700. So this is about the stock position as on as on 4th January. On 5th January, they are issuing 4 tons they are issuing. Sorry. On 5th January, 3 tons they are issuing. So issue price is always permanent, 242. 3 into 242 is 726. So before the issue, there was 15 tons. 15 minus 3 is now 12 tons. And 3700 minus 726 is 2974. Value minus value is the balance value. Any doubt, no? We have arrived the
No, sir.
standard price. We have arrived the standard price and we are using that at that price we are issuing. So whenever we are issuing, we are reducing the automatically quantity will get reduced and value also will get reduced. Whenever materials are purchased, the stores department, the stocks will increase. While preparing this stores ledger account, we have to assume that we are the stores in charge.
Okay, sir.
And now 4 tons are issued. Immediately before the issue, there were 12 tons. So 12 units or 12 minus 4 is 8 units. And they are issued at 242. 4 into 240 is 968. 2974 minus 968 is 2006. So like this will come. And ultimately, what is happening as on 31st January? What is the stock position? There are 5 units at 1,456 is the actual cost. If everything is you are buying at say even at 242, if the purchase price is also the purchase price is also same as issue price, and if everything is at happening at 242, the closing stock will be at 5 units at 242. 5 into 242 will be 1,210. So, but actual cost is 1,456. So it means if everything is happened as per the standards, your cost of closing stock should have been 1,210, but you have incurred a cost of 1,456. So it means you have paid more money, and 1,456 minus 1,210 is 246 is the adverse. A means adverse variance. Variance means difference. Direct material cost variance. So here the direct material, of course, price variance is 246. This is arising due to change in price. Okay.
Okay, sir.
Next, so the other methods, derived cost price methods. To derive means to obtain or to calculate. What is calculated is issue price is calculated. So they have given some information in this question. Question number illustration 11. Receipts and issues of an item of stores are made as follows. There was no opening balance. There was no balance before 9th January. So everything starts from 9th January. Receipts 10 units at 17 rupees. On 19th January, 25 units at 10 rupees. 20th January, 29th January issues 10 units and 20 units. Then on 30th January, 13th February, and 27th February, there was a purchase. And 28th, there was issue. On March 30, there is purchase. On 31st March, there was issue. What is the simple average of February receipts? What is the simple average price? Simple average price is the average of the prices of the purchases made during the month of February. So since they are asking for February, we are calculating for February. In February, what are the purchase? 20 rupees. The 20 units at 12 rupees. On 27th February, and 10 units at 16.9. There are only 2 purchase. Corresponding prices are 12 rupees and 16.9. Simple average price is 12 plus 16.9 by 2. 28.9 by 2 is 14.45. Okay, any doubt is there?
No, sir.
Simple average means sum of the observations by number of the observations. Here, what is observed and what we are finding the simple average price. So in February, there are only 2 receipts. So since we are adding 2 prices, we are dividing with 2 prices. And can you tell simple average price of January receipts? So 17 and 10. And 8, the third one is there. 17 plus 10 plus 8. How much? Seventeen plus 10, 27.
35, sir. 35.
35 by 3,
7.67.
35 by 3.
It's 11.67.
Okay. So that is what is given. Okay. So moving monthly average for January and February means, so 11.67 for January and 14.45 for February by 2 is 13.06. And similarly, moving monthly average for February and March. And next, stores ledger account under weighted average method for January. So here on 9th January, 10 units are purchased at 17 rupees. 10 into 17, 170. So now closing stock is 10 units quantity and 170. 10 and 170. Second, 25 on 19th January, 25 units are purchased at 10 rupees. 25 and 10, 250. So quantity plus quantity. 10 plus 25 is 35. Value plus value. 170 plus 250, 420. Actually, they should have inserted one more column. You please write 420 by 35. In the first case, it is 170 by 10, 17 rupees the weighted average. This is called perpetual weighted average. So 170 by 10, how much? 17 rupees is a weighted average for the first lot. And for second lot, it is second stock, it is 420 by 35. You know 420 by 35?
12.
12, sir. 12.
Or 12. So 12, you insert one column and write practically. And now issue is the 10 units are issued on 20th January. They have given on 20th January, 10 units are issued. So in the issue column, we will write 10, and immediately before the issue, just before the issue, what is the average price? Weighted average price is 12 rupees. Just you are telling me. So this is the only 12 is coming. So in this case, in the last column, they omitted by mistake. You write, so 170 by 10 is 17 rupees.
17.
Yeah, 420 by 35 is 12. So issue price will be taken as 12. So 10 into 12 is 120. So now quantity minus quantity, 35 minus 10 is 25. Value minus value is 420 minus 120 is 300. 300 by 25?
12,
12,
sir.
sir.
12. So that is what, again, with every issue, the price will be same. With every purchase, there will be weighted average price will change. Okay.
Okay, sir.
On 29 January, there is an issue of 20 units. So issue price will be 12. 20 into 12, 240. 25 minus 20 is 5. And 300 minus 240 is 60. 60 by 5 is 12. So again, 12 will be the weighted average price, because with every issue, it will not change. And now they have purchased 15 tons or 15 units at 8 rupees. 15 into 8 is 120. Already we have a lot of 5 units. And so 5 plus 15, 20. And value is 60 plus 120, 180. 180 by 20 is 9. 9 is the weighted average price.
Yes, sir.
Fourth question is the weighted average price is calculated at the end of each month and is then used for pricing of issues. of that month, what will be the value of the month end balance? So now quantities 10 units purchased on 9th January, 17th January 25, and 30th January 15. So total 10 plus 50, 25 plus 15 is 50. What is the total value? Is 540. Right? 170 plus 250 plus 120. 540 by 50.
9.
540 by 50.
10.8, sir.
So 10.8. And during the period, 30 units are issued. They are telling in the problem. 10 plus 20 is 30 in January. On 29th and 30th January. So totally 30 is the quantity issued. 30 into weighted average price, periodic weighted average is 10.8. So 30 into 10.8 is 324. Quantity minus quantity, 50 minus 30 is 20. Value minus value, 540 minus 324 is 216. And the January closing balance is the opening balance for February. And during February, they purchased 20 tons at 12 and 10 units at 16.9. It's given in the problem. Here it is given. 20 units at 10 and 27 units on 27th, 10 units at 16.9. February purchase. 20 units and 10 units. 20 units and 10 units. 20 units are purchased at 12. 20 12s are 240 and 10 units at 16.9. So 169. Already opening balance is there, 20 units. 20 plus 20 plus 10, 50. Value is 216 plus 240 plus 169, 625. So 625 by 50, how much? 625 by 50.
12.5.
Come on.
12.5.
Yes. So issues during the month of February is 40. It is given here, you can see. On 28th February, it is 40. Right? And so 40 into 12.500. Out of 50, 40 units are gone. Balance 10 and 625 minus 500 is 125. This is the opening balance for the month of March. During March, 20 units are purchased, 10 plus 20, 30 units. And 125 plus 400 is 525. Total quantity is 30. 525 by 30 is 17.5. Issues during the month of March is 20. It's given. March 20 units. So 20 at 17.5, 350. Balance is 30 minus 20 is 10. 525 minus 525 minus 350 is 1. Okay. So you can see up to this and also write all the problems. Any doubt is there, I will explain you. All EOQ based problems have you solved from the study material? Whatever, no, nothing is pending, right? Illustration 16, 17. Have you done? Any pending problems? No, you are solving. Still, you are solving out of the topics what I've explained, or anything pending is there? Because
Sir, I
Yeah.
will complete it today, sir.
okay.
Some more problems,
Still,
sir.
Why I'm asking, because if you are not solving then and there, you will find doubt again in future. So because that's why I'm coming with 1 day gap. So please solve it and come back. I will call you day after tomorrow.
Okay, sir.
Okay.
Okay, thank you.